It is the reality. It's just a philosophy of how you do business and how you want to take it forward.
We've got kind of a raging succession problem in this industry. We've got 20 years of labor shortage. Now, keep in mind, it's not just private equity, but also we've got registered investment advisors, we've got other investors looking at this market. It's really a question of how you look at this and how you measure the risk and what your alternatives are. In some cases, they don't have alternatives. The deferred comp programs got too large. The buyouts weren't really easy to do, so private equity solves part of that problem.
Hi everyone, welcome again to WTF Podcast. We are trying to figure out. Today we have with us a friend. I've been talking to him about what is happening into the industry. We have been interacting with him and taking his valuable guidance and insight. He's talking to top 100 firms, even top 500 firms, and he has understanding of, what managing partner, what leadership is thinking about. So today we have with us, he's going to share all these insights to us, Bob Lewis. Thank you, Bob. Thank you, Bob, for coming in.
Well, thanks for having me, Shawn. I'm with the Visionary Group. I've been doing this for almost 30 years now, exclusively for accounting firms nationwide. And I'd like to say that I've seen most everything. However, that's not always true. A new day can sometimes bring an interesting new challenge. So, Shawn, what questions do you have for me? What would you like to know?
Well, before we go to questions, Bob, and I know we are meeting here at the outset of PE Summit in Chicago.
Counting today, Private Equity Summit. It's actually a pretty good sized event.
Yes. And you are co-chairing the event. So,
correct.
First of all, congratulations for that. I'm looking forward to your speaking sessions and the panel discussions that is happening.
Well, so, now you set the bar really high. I'm just going to disappoint. But yeah, keep going.
And we informally talk a lot about what is happening. I have my questions. You come up with, this can happen, this can, So from that perspective, my objective would be, there are firms that I work with, which is probably doing 30 million in revenue to 4 million. So I would in terms of ranking from 150 to probably 1,000 or maybe more. These are the firms who really, have uncertainty, so to say, skepticism, so to say. So coming in from you would really be more, for them, it would be an advice that what is right for them. What would be something that they should be looking out for? What are the things that they should be looking before getting married to someone, so to say. So that's the objective. I want to lay out this.
Sure.
That is meant, this objective or this podcast is meant for those audience. So let's start. Let's start the question first. But you want to say something?
No, fire away. I'm anxious to hear these questions, Shawn. This is not pre-scripted either.
Yeah.
So I have no idea what's coming at me.
Yeah. Hopefully I kind of live up to your expectations. So first question I have is that let me hit the PE thing, which is elephant in the room.
This private equity in accounting now?
Well,
I didn't even know
that's how we say that.
Thank you for that advice.
So PE in accounting firm. Why it is become, since last 3-4 years, so attractive. It is not a discovery. It is not an invention. It is just old partner retiring. It is just a repeatability of the business. Is it just expansion of services?
Okay.
What is happening?
It's kind of a perfect storm. So most people think private equity entered the market because they're going to solve and change the whole landscape. What really happened is, we've got kind of a raging succession problem in this industry. We've had 20 years of labor shortage. So the succession teams, if you think about this, the average baby boomer is 68 years old. We have a labor shortage that's going to continue to drop. We've got a program at the AICPA that this talent pipeline that they're working to repopulate. Let's assume it's really successful and works. It's got a 6-7 year fuse. That average baby boomer is going to be 75 now. They're going to be gone. So who's going to take over these firms? So some firms have really good succession teams built, but they don't know how to sell their network. That's one of the biggest problems. Second is they may have, say I've got 4 partners leaving, but I only have 3 potential succession people. The number's too big for them to take the buyout on. So what do? That's how private equity entered the market, solving some of the problems with deferred comp buyouts, putting a different value on the firm. But what's happened now is, as a result of private equity, it's really turned the landscape upside down. So even a traditional deal now has different parameters on how it's closed. Not all firms are private equity eligible, so I know we're talking pretty much the 150 IPA list on down to like 1,000. right now the private equity firms have been focused heavily on really $10 million plus firms. That's been their big focus, and some very large ones. Obviously, the ones just closed this week, I think, or announced closings or acceptance of private equity money.
PKF and CRI.
Yeah, those are two that went down this week. Now, keep in mind, it's not just private equity, but also we've got registered investment advisors, we've got other investors looking at this market. The interesting thing is we're flooded right now. It's a little funny. It's a little funny, okay? We get 3 to 4 new private equity firms a week calling us to enter this market. I'm beginning, if I actually kept track, I think there may possibly be more private equity firms trying to enter the market than there are accounting firms. But we're not going to, I haven't been keeping track of the numbers, but the reason that private equity has been so popular is it does solve a succession problem, okay? It also does provide an immediate cash back and exit out for a lot of these partners. Also, it provides a lot of resources for a firm to invest in artificial intelligence, invest in offshoring, invest in opening up advisory, which they couldn't do on their own or didn't want to make those investments or didn't have the time to make them. So one of the things we see with staff inside a private equity transaction is what's not good for staff. We hear that all the time, it's not good for staff. That's not necessarily true. What's good for staff is now they have resources to do more things more efficiently, to be able to actually create a better work-life culture and make more money doing that. It's not right for every firm. And I know that comment is going to rub some people the wrong way. But the default is if they don't have an investment and they don't have a succession plan, what are they going to do? What are those younger people going to do inside the firm? It'll begin to implode and collapse. It's just another way to look at it. But Shawn, I've been talking for a bit. Why don't you fire away with something?
No, I mean, I think it is here to stay. It is the reality. It's just the philosophy of how you do business and how you want to take it forward. As you said, you want to take some chips off the table.
Yeah.
And this is your way forward. I mean, rather than looking at it from any moral perspective, so to say.
Well, you bring an interesting point. A lot of people look at this like it's a religious item.
Yeah.
Like years ago, and it still exists, wealth management. I will not bring wealth management into my firm because it's the wrong thing to do for my clients. It's an independence problem. How are they spun it?
Yep.
It's not necessarily the wrong thing to do. A lot of firms have made a lot of money off of wealth management in their client base because they've integrated tax and accounting for their client into one location. Private equity, people view that as, oh, we can't do that, it's completely wrong. And for some, if that's the way they believe, that's great, but for others, they're actually doing the right thing for their clients and for their staff. It's really a question of how you look at this and how you measure the risk and what your alternatives are. In some cases, they don't have alternatives. The deferred comp programs got too large. The buyouts weren't really easy to do, so private equity solves part of that problem, or an outside investor. But again, you gotta look at all their options. That's the thing, when people look at that, like, we always tell people, look at all of their options. Can you pull off the succession? Do you want to merge up into a non-PE firm? Do you want to accept private equity money? Do you accept full private equity money, partial private equity money? All kinds of options out there. Make the best choice. That's what we help these people figure out what to do.
Absolutely. And one more thing, because you meet a lot of managing partners, some of the mid-market firms, a lot of these partners are retiring, nearing their age, or nearing their age of retirement. Does this PE phenomena, traditionally when a partner retires, the younger partners take over. That's how the succession used to be managed.
Yes. It's still happening that way, but not all the time.
The majority of them is like that. But do you think the deferred comp model, the partners used to get paid when they retire, is going to change with PE coming in?
Yes.
Because the expectation is getting more money and upfront rather than deferred, something like that?
So for years, they've been talking about the partnership model line. Okay, because people don't want to, younger professionals, and I'm stereotyping a little bit, so please don't get on top of me if somebody disagrees with this. Stereotyping a little bit, younger professionals don't want to wait 30 years to get a deferred comp payout. They want to start making more money now, they want more bonuses, more stock options, and they may not want to be doing this in 30 years. So they may want to run 10 years and go into a different industry or a different business. So by waiting so long to get the deferred comp payout isn't necessarily attractive. Plus they're competing now against technology companies that offer stock options and things like that that are much more immediate. So when you look at private equity, they take the buyout off the table when they do the transaction because they cash out part of it, they pay some of it out over the next couple of years. Partner comp at an equity level, whoever's participating in that buyout will see a reduction in their compensation, but the younger partners won't see a reduction in their compensation. Okay, if they're not taking any part of the buyout, they're not going to take a reduction in comp. They're going to then get the money that's available to be able to do other things inside the firm. I also hear the myths of well, private equity came in and said, well, we're going to double our prices now. Well, in some cases that could be true because a lot of firms are underpricing, significantly underpricing in a labor short market. So doubling fees isn't necessarily crazy, or they're burning their capacity and clients that no longer fit the size of their firm. We do these really deep consulting studies inside our firm called a market value accelerator on practice. It's amazing how many firms are dealing with clients that are actually losing them money. But they never really look at it that way. They look at it as, oh, this is a $2,000 client. It's a $2,000 client they're losing money on, and they're not paying attention to the $100,000 or $50,000 client. And they're starting to go through that process now going, this is maybe a bad exercise. But there's a lot of drivers behind why that happens. And we need a 7-hour podcast to hit that.
Yeah.
So,
no, we will do that maybe some other day.
That'll be a really interesting and long podcast. Better cater luncheon for that one. So, yeah.
And we have a common client, I'm talking about the Salt Lake City client that we have.
Yeah.
And how PE acquisition has changed the dynamics of the whole business and how they've accelerated offshoring with us.
Yeah.
And what we have observed is once, and we work with few of them, and once the private equity guy come in, the mandate is very clear, which traditionally the decision making is in a smaller, it's in a partner group.
Made by the partners. Right.
Yeah. Now things have changed, and people are making faster decisions. There are deadlines that, and I want to talk specifically about one client of ours that once they got acquired by PVP, the mandate is that you need now 30% of your billable by 2025 moved offshore and build that team. So this deadlines, I've never seen these kind of deadlines in accounting firm before. Yeah.
Well, okay. I was very anti-private equity when it first came in. It was announced in the market, and I was saying, right? This is not really a good idea. Because you hear about the stuff about how they bought hospitals and then closed them and stripped them down. And there are some groups that have done that. I don't lie about that. We've seen that in the market. But what we see in private equity is not coming in the accounting sector and telling you how to do accounting, tax, or auditing.
Yeah.
And what I've learned from private equity, shamefully, after 30 years of running my own company, is I'm not a good manager. I'm not hard on people. I don't set enough deadlines for people. Private equity brings a little more discipline to the table. And when you talk about like a mandate that 30% of the business is moved offshore, the reason they're doing that is you're burning out the staff who has got a capacity challenge to start with. Why burn out the staff on all this excess clients when you can offshore or use more artificial intelligence? You want to keep the staff happy, you want to retain the staff. They don't want to be working long hours. And if you don't offshore and you don't use artificial intelligence, what are your choices if you're going to try and support that client base? It's a model that needs to happen. So they do put some mandates in. Do they hit all the mandates? I don't think so. But if we're making progress towards it, it's what they should have been doing in the first place. So it kind of takes some of the decisions away from the partner group of making more passive decisions that I don't want to make changes to. We accepted the money, now we got to make some changes. But I will tell you one thing, nobody's getting cut in a private equity transaction. They aren't coming in and going, we're going to cut 20% of staff and move it offshore. We're going to put 20% of the offshoring in place to augment our staff, and then we're going to add bigger and better kind of clients so our staff has more skilled clientele to work on, which is what they want to work on anyway.
Let me touch on, let's go away from capital and financial numbers. Let me touch on some intangibles associated with this business. So traditional partnership model, some of them have, while still separating ownership and management theory, I understand. But some of these have, some of these companies have, or firms have actually separated where they have board in place while owners continue to be the partners in the business, but they have COO and CEO, they have C-suite in place. And my question here is, does personal ownership angle going away would keep that incentive for people or partners, so to say, to keep team and clients stuck to you, to do right by the client and take that element of uncertainty into the interest of the client, So when this personal service business transforms into owned by private, either majority or fully, largely. So in those cases, when this element, I'm talking about very intangible this is the fabric which keeps all 20, 30 partners together. I'm not talking about 100 partner firm because those partners operate like an employee. But when I'm talking about 5 to 25, they operate like a small group of people who are closely connected. Everyone has a voice on the table. So, and that leads me to second question. So, I'll give you for the full time.
Layering the questions in on me. Okay. Go on.
That some partners feel that my voice would be stifled, and some partners want to give up that control and influence and clout. So
Yep.
that's the two things I have.
Okay, we see a lot of partners not wanting to do the decisions they need to make with what we talked about before, these different options. Whether you go private equity or not, doesn't make a difference. The labor shortage is going to continue to shrink. So I'm going to be either forced to adapt. If I'm just running a regular closely held firm and I'm not merging upward, I'm not doing any private equity, I'm doing nothing but remaining independent, I still need to adapt. I can't attract the right staff, I can't pay the right staff, so I don't change my pricing. I can't put the unreasonable burdens on them if I don't look at offshoring or outsourcing or cutting my clients out. If you don't want to offshore or outsource, the only option is you got to start to thin the herd of what the clients are you're working on because you can't keep up the pace. No matter what, the underlying theme on this is artificial intelligence. Everybody's talking about it. It's like, it's the new savior out there of the world. It's coming. And if it's not artificial intelligence, it's going to be another version of technology. And firms are going to have to invest in it, manage it, control it. And a lot of people can't do that. The other part is accountants are historically known for being a little risk averse, conservative. So if I'm a 60-year-old accountant in a firm and I've got 5 more years left, what I don't want to see is new tax software, new technology, new systems, because I just want to put my next 5 years in. I've already done my math on how much money I want to make and need to make to retire and kind of move forward. Now, not everybody's like that, but a lot of them are, and that's what resisting some of the change. It's also forcing a lot of these M&A deals because what's happened is the staff underneath them don't want to wait 5 or 6 or 7 years for me to leave, and they move elsewhere, and their succession team starts to implode. So I'm not sure if I've answered all your question yet, so fire me off, because you layered a lot of questions out in one shot.
Yeah. So I think the second question you answered about, this adaptability of the firm. The first question was the personal touch and the ownership.
Sure. Okay. So this has always been a relationship business. It's kind of funny because people don't understand. They think we're providing a tax return or an audit or accounting.
Some relationship.
First of all, your clients, the only reason they engage anybody to do a tax return is they can't do it themselves.
Mm-hmm.
So no matter what the level of work the accountant does, I can't really judge the quality of the work because the technical nature of it's over my head. Same thing with accounting. The auditing, if I've got a good CFO controller, he or she's going to look at it and go, I know it's a bad audit process or whatever, but even if it's an audit and I'm not well skilled. So really what I'm buying, Shawn, is the relationship for you. So I always use the analogy, if my car window's broken, the window doesn't go up and down. I go to a dealer or I go back to a repair shop and they press the button, the window goes up and down. I know they did a great job fixing the window, okay? But I have no idea my other stuff. So what I'm really buying is the relationship with the accountant, okay? And those relationships change as clients get bigger, sometimes as the accountant doesn't keep up with where they need to keep up with. And the biggest thing is transitioning over the relationship, and that happens with or without PE, okay? So any kind of a transition, everybody eventually retires. So you gotta start transitioning clients over to younger staff that's gonna be there for a while. The question is, if I don't have the younger staff or if they're already overburdened, how do I make that transition? This is an extremely relationship-driven business. And yeah, you could lose some clients when any kind of transition occurs. Reality is in this market, though, where are they gonna go? I hate to say that. We got a huge labor shortage. We got a demand and supply. The supply is short, our demand is high. Often people will say, Shawn, you've doubled my fee, okay? And I'm like, oh, Shawn, I'm looking elsewhere. Thanks, appreciate that. I look elsewhere, nobody wants to take me, or I find that the fee you doubled me is still lower than the fee I'm getting quoted from the few people who have talked to me, and then I come back. And then if you're really smart, you come back and say, wow, well, that window's closed, it's now an additional $5,000 or whatever. And people will still sign up because they've got nowhere to go and they need to get the work done. It's required work.
And again, if I come back to the first question is,
sure.
My view is, again, you are a privately held business, right?
Mm-hmm.
Also privately held business. So I'm saying that personal service business, your relationship, I always tell my clients that it's not the number of clients you have, it's how many relationships you have. That's how you measure as well. When this happens and people start, this relationship becomes transactional, I don't know. I'm just asking this question that you have an accountability and a responsibility right now do right by your client.
Yeah.
And when I say right by your client, it is protecting the interest of the client. It may also happen that you might take a different tax position. Now, when you do not have, and of course, you look at the tax return more thoroughly, you do your planning advisory more thoroughly. At the end of the day, an individual is signing on the return or an audit report. It's not the PE who is going to the jail if something goes wrong. Has that happened before? Answer is no. Yeah.
We're going to find out.
We're going to find out, yeah.
But they're the owners now, technically. So.
Technically, yes. So, and what is happening is a test entity remains in an alternative practice structure.
Correct.
A test entity remains, but that entity practically does not retain any cash flows. That is transferred to the advisory entity with most of the administrative service agreements that are in place.
Correct.
So practically this entity carries the responsibility of peer review liabilities, but do not have anything if something goes wrong except partner's personal responsibility. So while how many partners would be ready to be remaining that LLP for longer term, which is in a test entity at the end of the day, which does not retains any money. I could be wrong. My knowledge could be extremely limited here, but you can throw some.
No, you're kind of on track. But here's the issue, though. How do I run a full-service accounting, tax, and audit firm without having an audit arm? So, if I'm going to do the audit for a client, normally the tax return is also pulled with it. Now, there's an independence problem. I can't do the accounting if I'm doing the auditing, obviously. But, a lot of clients need that kind of full-service support. So that business model is still going to be there. The question becomes, Shawn, and this has been intriguing me, is I think the audit sector is going to continue to shrink in terms of supply of people doing it. I think what's going to happen is a lot of those firms are going to break out into 100% audit firms, niche specializations, and we're going to see maybe these private equity companies shed some of those and then work in conjunction with a completely independent audit function that provides just the audit services for the client, while the private equity firm provides all the accounting, advisory, and tax with no independence concerns. So we'll see. That's all future to be seen. But there's been a major concern that there's going to be too few auditors left. And we've got loan covenants for private industry. If I got a bank loan, I got SEC stuff, I got all kinds of stock options, I got all kinds of different audits, benefit plan audits. Somebody's going to have to do that. And part of the theory is it's going to be automated. And I know a lot of audit work is now being moved overseas. But at some point, even the overseas providers are going to have a problem with being able to provide enough people to take care of all of that.
Is valuation getting richer and richer with more money chasing lesser number of assets? And I'm talking it from the perspective of $15 million firm looking to acquire $3-4 million firms.
Yeah.
And I'm sure you must be having a lot of inquiries around that.
The adjusted EBITDA is really the key to this thing. What makes some firms really strong could be other variables like, I've got a great bench, I've got a good location, I'm in a strong niche, I've got some advisory services or other investments that can make you more valuable. What could make you less valuable, even though you're more profitable, is you're doing a ton of billable hours. If your partner's billing, 1,500, 2,000, 2,500 billable hours a year, it brings the value way down, but the firm thinks that they're really profitable because they are. They're not doing 30% drop to the bottom line, they're doing 50. It's all on partner billable time. And you really can't run, that's not a good firm to acquire. You need to bring those partner hours down. And to do that, that's an investment you need to make, which brings the profitability back down. But that's sometimes where people get, I'll use the word confused or have a disagreement on value, but nobody's buying a book of business anymore. No one is buying a book. They may be buying a location, pay a premium because I want to get into a certain area. But even then, it still has to be a decent firm with a bench.
Can you put a number to, let's say, in different pockets? For example, a firm doing 5 million, firm doing 5 to 10 million, 10 to 15, 10 to 20. How the valuation multiple? I know it increases, it progressively increases, but if you want to put a multiple, and again, nobody's going to hold you at that multiple, it's just guidance.
Yeah. Right. Yeah. And if somebody wanted to pay it, that's great too. By the way, don't get confused too much on the multiple when you're looking at these things.
Yeah.
The multiple is a piece of the equation. We need to look at what the adjusted EBITDA,
Yes.
and then the adjusted EBITDA. Then I need to look at the earn-out target. I need to look at the working capital. I need to look at are there preferred dividends in this? Are there management fees in this? There's all kinds of ways to make a multiple look really attractive. In the end game, not so attractive because of other elements. But here's what's happening. And if we're going to go private equity now, I'll talk private equity-ish.
Sure.
But the valuation is about the same. If I have a $5 million firm with a 30% profit drop before any equity partner compensation, and I do realize profits are different, but 30% is kind of like a norm. That's $1.5 million in profit before you or I get paid a thing if we both own this firm. Okay? If you and I are going to continue to stay in the firm, we still have to get paid compensation. Let's assume you and I are the only two partners, we're splitting that $1.5 million. We're going to have to cut our comp to probably $750. Okay? So it's $750 and a multiple of like 5, which is what's happening a lot with these $5 million firms. $750 multiple of 5 puts me like 4 something on a $5 million firm. There's not enough EBITDA, adjusted EBITDA, to make what they call the scrape, to make the number worth more. Now, if I'm a large firm, like some of the ones that have closed recently, I don't want to mention any names, but but it's public information, but some of those are going for like, 12, 14 times.
Progressively, you under 5, you get about 5, 6 multiple. 5 to 10 would be
6 to 8.
6 to 8, and 10 to 20 would be another 8 to 9.
Probably, or if not, maybe a little higher, depends on.
And once you hit 20, you cross 10 multiple. Once you cross that 20 million benchmark.
Not necessarily.
Not necessarily.
No. A lot of this has to do with where their profitability is and what investments they've made.
And what debt you have, so enterprise value.
So like when you even mentioned like the 6 to 8 for the size grouping, that 8 needs to be a good firm. Now, the other part is, here's the deal. It may be worth 7 to me, but to that person over there, they need to buy a platform to get in the industry, they pay 9.
Yeah.
Now, unfortunately, what happens is we're seeing in this market now is people are making offers. We'll go back to the $5 million firm, offering $12 million for a $5 million firm. The deal doesn't close. And I have no idea what the content of that deal transaction is they put in place, but it's not a realistic purchase. It's no way to make that work. So we're seeing a lot of the other players coming into the market who can't get the larger firms right now, bidding on the smaller ones high and tainting it. We're also seeing a lot of these firms, these private equity firms, calling like $1 and $2 million firms, which is completely befuddles me on how they're going to do that. But when you're looking at acquiring a firm, Shawn, there's really 2 considerations. One, we need to open up a platform firm. So we want to open up a firm in Chicago. I'm in Minnesota. I want to open up an office in Chicago. I need a platform. That's typically about $5 million on up, and I need to make sure that the leaders will be there for a while. I can't have leaders leaving in 2 years, or I can do a tuck-in. So the tuck-in is I already have an office in Chicago, and I can tuck your practice in, Shawn, and you want to leave in 3 years, or maybe you're at 30, but I can tuck you into my location, and you could be smaller, and we're good to go. You could be a $2 or $3 million firm, we could still make that work. But a $2 or $3 million firm to build around as a platform is almost impossible. And that's where a lot of firms get confused, because they're thinking, they have a firm that's really valuable, but they may have no place to put it. And if I've got no staff, no real solid bench beneath me, firm becomes way less attractive for me to acquire, especially if I'm leaving in the short term. So,
one question. So let's take an example of a firm doing 15 million in revenue, 70, 80 people, 6, 7 partners, 8 partners. You are advising all of them. You have a valuation multiplier program, I have heard. I think that helps them in.
We have this thing called a market value accelerator.
Market
Not
value
to be boldly selling on your podcast.
But market value accelerator program. So idea is you help them plan and build their practice in such a way. Sorry, go ahead.
Yeah, no, we help them figure out, first of all, help them figure out what their gaps are. What you're thinking versus how I'm thinking, what the rest of your partners are thinking. That's a big thing. Second thing is, we do that via survey. Second thing we do is we do one-on-one interviews then with the partners, which we're going through your survey results, your specific ones. We do a little education at the same time and getting to think a little different. Then we take all your data and we dump it into, not just financial data, we look at your production results, and we dump it in and we start using Power BI on it. We create these cluster maps of what your client base looks like, and we show you, look, here's where you're burning a lot of your capacity. These are clients that are underperforming. We physically go in and look at the results, these are 80% realization clients, and here's how much you're burning on 80% realization clients, and the size of the client and the profitability of the client. So when we present that to you, it becomes crystal clear that, look, we've got to make some other changes here. We also look at when we have the data, partners. So one of the ones we did recently, we did an analysis showed how much write-downs were happening by partner and how much write-ups were happening by partner and by department. That was eye-opening. Yeah, it was very eye-opening. And then they've decided now to shed a bunch of their clients because the clients are causing a lot of these write-downs. Part of the problem in a lot of these firms is, I hate to say this, but I'm going to because it's reality. A lot of the partners aren't good at selling and bringing in new work. Some of them are really good people. They do tremendous tax and audit and accounting work, but typically there's a limited number of people that bring in material new business. So I don't want to lose my clients if I'm one of the people that don't know how to replace them well. So I'll continue to hold on to clients that no longer fit the size of the firm I'm at. I was a $5 million firm, now I'm 20. At $5 million, that client was great. At 20, it may not be. And they're having a hard time coming to grips with it. Plus, a lot of these people, we talk about relationships, a lot of these people become their friends. It's hard to shed them as a client. But when you don't do that, you're really hurting the staff that's working on them, because if you don't charge enough for the work, you don't have enough money to bonus the staff people that are doing the work to keep them and retain them. And that's a big problem right now, is keeping people in. Getting them is hard enough, but you don't want to train them for 3 years and then lose them somewhere else who's going to pay $20,000 more because they don't see a future in your firm. That's a huge issue going on right now.
Yeah. Well, I have a couple of more questions.
Sure.
Related out. So now let's think it from an employee perspective.
Sure.
Perspective where an employee sees. So I think it was CRI's announcement or somebody else. It was specifically emphasized in their announcement that while they have raised capital through private equity, but I don't know which firm could be wrong, but there was a specific highlight in the announcement that the firm remains, majority control of the firm remains with the partners, and and we want to remain like that, and we will continue to remain focused on our team, talent, and client. So that was a part of a press release, which means somewhere they fear that the talent would start thinking of them in a different way. What will happen to them? So how leadership? So two questions: what would the concerns on the talent side typically, and how our leadership should handle that?
Okay, so Shawn, in every transaction, whether it's going into an upward merger or you're going into private equity, take your pick. Maybe even an internal succession, it could happen. Somebody's going to be unhappy and going to leave. I want to work for a smaller firm. I don't like the new leadership, even though the leadership looks like it's the same leadership with the same partners. I don't like how we're operating. I don't like how we have to change a system or do something different. Everybody hates change. I'm a little bit of a change junkie, but I look at change as if I don't change and I'm standing still, I'm going to die. Okay, but I run a different business model than a lot of organizations do. And I see myself, if I get stuck in the mud, I'm never going to get ahead. People hate change. So you could double their compensation and they still don't want to go into a large firm. Mm-hmm. That's going to happen at any deal. But the other thing is, what's going to happen is if you don't do anything, people are going to leave because there is no change. And what normally happens is the people that leave because there's no change are the performers who do not want to leave. It's your superstars, it's your A-level people. So I look at it this way. There's like A, B, and C kind of performers in the firm. C people show up, they do the job, they may punch the clock a little bit, it's fine. The B people, they push a little harder, they're a little bit more, acceptable to things happening, but they're really good people. The A people, they'll walk through a wall for you. Those people, you got to really irritate for them to leave. It's the Bs that are going to leave. And it's some of the A's who eventually get frustrated, and what you're left with is C's, and in this market, maybe some of the D's. Lack of change can kill these firms because it's really hard to recruit young professionals who don't think we're going to have any more auditing or any more accounting or any more tax work because artificial intelligence is going to do it all. It's hilarious, but the perception is from the younger generation that's all going to be automated. So what's my skill set going to look like in 10 years if I go into a firm that doesn't offer me consulting direction or looking like the progressive a different way? I'll go to a firm that looks like they've got it. Now I may end up going to a firm that looks like they haven't, they're doing the same basic thing they would have done at my firm, but perception is reality.
I think one thing that I would always say, because I also work closely with firms, is whenever they're making this kind of shifts, especially I'm talking from a private equity standpoint right now. Mm-hmm. first of all, you need to understand this preparation needs to start in advance. You don't want your team to be caught by surprise.
Oh, no.
Number one.
Everything needs to be transparent.
Everything has to be start 6 months in advance. Second thing, you need to know that what the first perception employee would have in their mind. They talk to you differently, but then when they are out there, talking to each other, they talk differently.
Yes.
So you don't want to. They think that you're taking up money and selling them out. You don't want them to feel like that. For that, right messaging, right conversations, and right transition from is super important, and giving them way forward for their career advancement. How is the firm shaping up?
Yep.
So this plan, and on top of them, the leadership that is coming in, how that leadership is getting in front of that audience. Especially I'm talking about, because I always say this, they look at, I'm one of them. They look at this people as an ugly capitalist, so to say. So while I'm one of them, and
you heard it here first. Shawn is an ugly capitalist.
Yeah.
Okay. All right.
So guilty as charged, So, but yeah. So I'm saying, when we look at it from that standpoint, the uncertainty is what's going to happen to my job now? Am I going to start working and calling somebody else as my manager or as my partner? So that this kind of uncertainty and cautiousness needs to be addressed.
So here's the answer. I mean, it's really easy. You've got people who are going to always look at stuff half empty. I look at that, if we got new groups coming in, new changes coming, how can they gain ground? What can I do to gain ground inside this organization from this change? Because you know what, it was stagnant before, and now I'm able to get ahead. I can see more opportunity. But people get confused on that.
It's going on. Go ahead.
People get confused on the fact that like if I bring in 6 more partners from a merger, there's no partnership opportunity or no growth opportunity. It's the exact opposite. It accelerates the growth opportunity firm because now you create a bigger firm and you've got more opportunity to go out and advance your career. And if you want to be passive and sit in the back room and wait for it to come to you, you're going to be one of those people that's always half empty and I'm going to leave, or I'm not happy about anything. They put free donuts out in the lunchroom and they're not healthy, so I don't like donuts.
So yeah, some of the employees, I think, are the ones who are open to change and always looking for it. For them, it is an opportunity. I always say this, a lot of reservations are around outsourcing. Now we have expanded in multiple areas, but outsourcing is one thing that we still do with CPA and accounting firms.
Sure.
And we don't get buy-in from onshore teams sometimes. But then there are some people who would make sure that I'm on top of what is firm's partners' intent. And when they hit this, that my firms and my leadership is wanting this, and if some people are not on that side, but very few people are on that side, they make quick inroads to that career advancement. We have seen that in smaller firms, especially 30, 40 member firms, those people who raise their hands and say, I'll do it.
Yep.
Well quickly gets into, their, career advancement, because this is an opportunity. Because managing partners and partners are looking for people to raise hands. And there are some young people who want to do that. So, people who are on top of, this kind of change, they'll raise their hand and they make sure that let's get aligned to what the objectives are.
Yeah.
Don't just have preconceived notions of, so to say, that, this is bad. I don't think it that way.
I think it all comes down to attitude and mentality. Okay, when earlier in my career, I used to actually be an accountant a long time ago. I worked for a large corporation. I would go in on Saturdays. They put me in charge of a department that I was woefully not qualified to do. I just want to share that with you now. I ran 3 departments. I ran accounts payable, accounts receivable, and I ran the general ledger accounting. I had a staff of like 40 people in 3 different departments. I was like 30 years old. I look back at that, it's kind of scary. But I used to go in on Saturdays because we had a major problem in the accounts payable department when I inherited the job. So I would go in on Saturdays and work from 8 to 12 because I needed to get these things fixed. I needed controls in place. I needed bills paid. I needed vendors stop calling us because of these problems. I did that because it helped me get better. It helped me advance. And it did get me to the next level of job inside that organization. But if you don't take the risk, you don't want to stand up and do it. And I didn't ask for extra compensation to do it either. I looked at it as how do I make myself better and stronger. But you got to have that attitude coming into it. And it is true. When a firm is acquired or merges up or PE, however direction it goes, there needs to be a lot of outside leadership coming in and making sure people are comfortable, because you want to make sure people know we're not changing the business structure. Some things may change. They're not coming in and changing your culture, unless you've got a really bad toxic culture, which you probably would want changed then in that
So
case.
he doesn't want to run the business.
No, they want to run it.
Yeah.
They're looking for, they're trying to, they don't want employees, they don't want a boss-employee relationship. They want people who are thinking and progressive and are willing to do different things. They're looking for leadership and different kinds of leaders, all different through the channel. Some of our young leaders that are coming at a different stage than the more mature ones. So.
Well, yes, and but just one last question.
Sure.
And how are regulators looking at this?
Wow.
State regulators, AICPA, how are they looking at all this? I mean, we haven't heard any commentary specifically from them, but these are the stakeholders.
We're looking.
They're looking.
It's all speculation, all rumor, because I'm not involved in the state regulatory or at the AICPA or the PCOB level, but they're looking. They're looking at, do we have independence concerns? Is the quality of the audit going to be compromised? Are we not going to have enough auditors? That's one of the things I know they're looking at pretty hard right now. And it's a valid concern. We don't have enough accountants, much less we're not going to have enough auditors. It's kind of a good equation.
Yeah.
And they're worried about things like, I can't cover my loan covenants. I don't have enough people who want to do SEC work. So like the regulations now in SEC public accounting kind of audit work, get harder and harder. A lot of firms are now going, I don't want to do that anymore. The risk is just too high. Somebody's going to have to do the work because, if I'm not mistaken, that all does impact the stock market at some point.
Yeah.
It's all kind of tied, right? Which means your investments you made in your mutual funds are being impacted by those decisions made on the audit on the publicly traded company that's in your mutual fund.
Yes.
So it's an interesting change happening. It's another layer of change that's going on because of all these changes. But you know what? This was happening no matter what. It just, when private equity did the whole change, this is just an awakening.
No, but I mean, the degree and the extent of this is happening is much different than what it used to happen. You might have.
Yeah.
So we are sitting here in a piece, in Chicago, and you have, probably 80 firms here and about how many, 10 or 20 private equity sitting. You're one of the co-chairs.
Maybe a few more than that.
Maybe a few more than that, yeah. So
Yeah.
this has never happened where you have private equity and accountant in the same room, So,
Yeah.
I mean, while we have examples of 30 years old of alternative practice structures or, how basically the businesses have been run by private equity, but the degree and the extent of shift that is happening right now is in our industry is much more magnanimous than it has ever happened before.
It's not just alternative practice structures for private equity. Firms have been looking and some have done it, create an alternative practice structure inside their firm with no intention of going private equity because they're looking at insulating the audit risk from the rest of the practice. So it's an interesting model shift that's been changing. Look, there's going to be a solution
but
to
there's
this.
one difference there, and I'm
Yeah, go ahead.
just playing devil's advocate here.
Sure.
One difference is basically those entities remain funded in their own way. The fees are not the advisory service doesn't suck all the fees
Correct.
to them, right?
Yeah.
So they remain independent. It's it's a reflection of ownership in both the companies by same partners, some shareholding here and there. So the only point of difference is there is no stringent administrative service agreement, and if that audit company LLP wants to be sold tomorrow, that can be sold. And some firms have separately sold audit business and advisory business. So yeah.
And where it's getting a little more complicated too is we've got like if there's outside ownership and you're auditing this company and this company's got owners that are involved in the outside ownership. I mean, the independence rules are getting a little more, it's not that they're more complicated, but the trail of finding out that, Shawn, you're a stockholder in this company that we're auditing, and you're also an investor in the accounting fund that bought the firm. It's getting more complicated. But I think, they have to iron this stuff out because eventually financial markets would collapse if we didn't have these rules and structures in place anyway. They just need to change, and change is hard.
It is hard.
Yeah, it's really hard. And you know what? You know who doesn't want to pay for change? The client, who has to pay more for their audit because we've now got new regulations that need to be checked, like that BOI thing going on right now.
Yeah.
They're checking for fraud and
beneficial owner's interest.
Yep. And so here's the deal. So if I'm actually running a company and I'm laundering money through it, that's not gonna stop me. It's just a form I'm gonna fill out. I don't think that's gonna stop me from changing from money laundering.
It's
By the way,
regulation.
I don't have any way to launder money in my company. I wish I did, but I don't. I don't know the cash type of business. But it's going to happen no matter what. And sometimes I think some of these rules they put in place are just a little bit excessive, but we'll see.
But yeah, last question. And let's say you are advising a firm and they doesn't want to go private equity route. You've already given advice: be agile, adaptability.
Yep.
You talked about better ready for the talent, better be ready for the talent. What are the other 2 or 3 things that they should be considering?
So we call it our inflection point. Okay, so we say, look, can you pull off an internal succession? Yes or no?
Yes.
Maybe. Okay, then let's look at your succession and make sure that's not a no. So if you can't, do I need to merge upward to do this? If I can pull off an internal succession, what do I need to do to remain independent? Like, how do I attract staff? Do I need to look at my clients? Do I need to look at how I price? Do I need to look at partnering with somebody to do like advisory services or other pieces of stuff so my clients, who I've got 1,000+ clients who are looking to exit or do something different, can get the advice through me, if not directly from me, through me to a partner that I've had and brought in. If they don't have that model going now, I don't know how they're going to be able to sustain, because if they're just sitting there doing the same thing over and over again, unless they're really lucky or really deep niche, I don't see how that's sustainable. So that would be my one thought if they're trying to remain independent: exhaust all options of how you would do it. And if you think you want to do it, what's your plan? And it has to be a concrete plan, and there has to be somebody executing it. And that's where we see firms fall apart.
Thank
They
you.
don't have execution.
On that note, we would like to thank Bob for sharing this insight. Thank you for taking the time out.
Yep.
I hope you enjoyed the rest of the PE Summit in Chicago.
It's a busy day today.
In your backyard. You stay in Chicago, right?
I'm at Chicago. This is an easy one for me. No travel.
No, sorry.
My last flight was last week.
Probably accounting today made sure that they do it where where we have most of the people, most of the what we call the hot shots of the M&A world of accounting stays. So that's how.
I'd like to think that, but I think they had an agreement with this hotel to run it.
Okay.
That's probably why they did it here. But I'll do it with your effect. All the hot shots are here. Yeah, that's it. Yeah. I love that.
But thank you, Bob, for taking the time out. Lovely talking to you. Always glad to speak with you and interact with you.
Appreciate it, Shawn. Thank you.